how do market forces of demand and supply operate to ensure that resources get distributed optimally. If you are driving on this highway, it does not mean others can't drive on this highway at the same time. That means the consumption is non-rivalrous. These goods carry what is called positive externalities. The benefits of these goods, their consumption or their production, does not remain constrained only to the sellers or the buyers of these goods. They are available to the general population at large. If you look very closely, revenue expenditure is the expenditure which the government requires for its day-to-day functioning. Gross fiscal deficit is an indicator of the fresh borrowing requirements of the government. Hello and good morning everyone. My name is Ranchan Kaul. This is the second last video in our series on NCERTs for UPSC Civil Services Examination. Today, our topic of discussion will be public finance management. In your NCERTs, this chapter is what you call budgeting. Now, to understand this chapter, we will go back to our previous discussion on what the role of the government is. And here we have to speak of the role of the government from an economic perspective. Last time we had discussed what markets are, what optimal allocation of resources is all about, how do market forces of demand and supply operate to ensure that resources get distributed optimally. The central concern of economics is the optimal allocation of scarce resources. And free market enthusiasts, they argue that it is the market forces of demand and of supply which together will optimally allocate our resources. But the problem is that we cannot always rely on markets. Markets are also prone to failures, something that we call market failures. We had discussed this previously also as to what are the various instances of market failures. One instance of market failures is what is called public goods. Markets fail to provide adequate quantity of public goods. Firstly, what are public goods? Now, in terms of classification of goods, when we look at two properties, one is called excludability and one is called rivalry. When you look at two properties of goods, excludability and rivalry, on the basis of these two properties, we can classify goods into several types. One type is what is called public goods. What are public goods? Public goods are those goods which display these two characteristics. They are non-excludable, they are non-rivalrous. What do we mean by non-rivalrous? Non-rivalrous means that use of these goods by one does not affect use by another. For instance, if you can imagine this to be an apple. If I buy this apple and if I take a bite of this apple, my bite is going to leave one bite lesser for you to consume, which means my consumption of this apple is rivalrous to yours. If I buy a shirt and if I use this shirt myself, my consumption of this shirt is rivalrous to yours. So long as I am wearing that shirt, you cannot wear the same shirt. There are goods whose consumption is rivalrous to each other. That means use by one affects the use by another. But there are goods whose consumption is non-rivalrous in nature. Which means what? Which means if you use some of these goods, it will leave nothing lesser for others to consume. For instance, the class that you are consuming at this point in time. Just because you are watching this video lecture does not mean that other people are getting so many minutes lesser. Everybody can sit and enjoy the class, and the consumption of this class by one is not going to affect the consumption by others. You go to watch a movie in a theater. When you watch the movie, does not mean that this movie is going to be available lesser for others to watch. All of these people who are sitting in the theater can all experience and enjoy the movie all at once. Use by one does not affect the use by other. Similarly, air. If you breathe clean air, does it mean that other people have that much air lesser? Certainly not. So consumption of air, once again, is non-rivalrous in nature. Public goods display the first characteristic, which is that they are non-rivalrous in nature. Their consumption is non-rivalrous. Consumption by one does not affect consumption by the other. The other property that public goods display is that they are non-excludable in nature. Now, what do we mean by excludability or non-excludability rather? It simply means that it is either physically impossible or it is prohibitively expensive to stop the non-payers, also what is called the free riders, from using the good. Which means it is extremely difficult. It is going to be either physically impossible or it is going to be prohibitively expensive for us to stop those people who have not paid for the same good from using it. That part is called non-excludability. For instance, consider that there is an 8-lane highway connecting Delhi to Mumbai. This 8-lane highway has enough space for people to be plying their vehicles. If you are driving on this highway, it does not mean others can't drive on this highway at the same time. That means the consumption is non-rivalrous. Secondly, is the consumption excludable? Certainly, it can be excludable if you fix 2 toll booths here. You can imagine that we will allow only those people to ply on this highway, those people who have paid any taxes, toll taxes. But from Delhi to Mumbai, there is about 1,000 kilometers of a road journey. In these 1,000 kilometers, there will be many areas which are unmanned, unsupervised. And in those areas, you will find people, they have destroyed the side railings, they get onto the highway, and then they take off at another place where the side railing has been destroyed. Can you stop these non-payers who are avoiding a toll tax, who have destroyed the side railing, who are using this highway for free? Can you stop them from using it for free? In that case, you will have to deploy so many forces to stop these free riders from using this specific highway without paying a toll tax. And can you imagine how much force is it going to take for you to ensure that no person uses this highway for free? It is going to be extremely, extremely expensive. This property is what is called non-excludability. And keep in mind that if a good displays non-excludability, it simply means that you cannot stop free riders, you cannot stop the non-paying users from consuming this good. And if a good is non-excludable in nature, it simply means if a good is non-excludable, it simply means that it is going to face a free rider problem. That means there are people who are using this specific good for free, or you can say without paying. And when you see other people are using the same good without paying for it, will that induce a willingness in you to pay for the same? Imagine that you are paying a toll tax for using this 8-lane highway every time, but you know that there are some people who are avoiding the payment of a toll tax and are still using this specific highway. Will you not feel like I should also not be paying? If a good is non-excludable, it simply means that your payment for the same good does not make that good exclusive for your consumption. Other non-payers are also going to be using it. And what does this hurt? This free rider problem hurts the willingness to pay. Imagine this, that you order food in a flat for yourself. Your flatmates can eat this food any given time. Will you then want to order food in your house? You took them out to a restaurant where you thought everybody is going to be making a contribution and people will enjoy a meal outside. But other people did not pay for the meal. Only you had to pay for the meal. Is that going to make you more willing to do this more often? Same is the scenario here. When you are paying for something and others without paying for that thing are enjoying the same, then it induces an unwillingness to pay for the same amongst others also. What does the free rider problem hurt the most? It hurts the willingness to pay. And now remember that if consumers are unwilling to pay for a specific good, will there be any market demand for it? There will be no market demand for it, because demand is what? Demand is the quantity of a commodity given its prices that consumers are both able and willing to pay. If there are consumers who are unwilling to pay for a specific good, that means there will be no demand for this good. There may be a desire, everybody may want to have this good, but there will be no demand for it because there is a specific technical definition of demand. And if there is no demand for these goods, quite obviously, no private person will be willing to supply the same, which is what is the first instance of what is called the failure of markets. The first failure of markets is in terms of providing public goods. Public goods are both non-rivalrous and non-excludable. Since they are non-excludable, people don't want to pay for them, and if people don't want to pay for them, which supplier will then want to supply these goods? Now this is one instance of market failure where complete reliance on market forces of demand and supply will mean that the economy will not have adequate number of public goods. Therefore, some person will have to produce them. Similarly, there are goods which carry externalities. The other cause of market failure or the other case of market failure is externalities. Some goods carry negative externalities, some goods carry positive externalities. Externality simply means the effect of consumption or the effect of production of these goods lies not only on the two parties between which there is a contract of buying and selling the same goods. The impact falls on others also. For example, production as an activity. Let's say we are talking about production of cars. Now, suppliers produce cars. Why? Because there is a market demand for it. They produce cars, they sell these cars to the willing buyers, but in the process of production of cars, the air gets polluted. There is pollution of air that may happen. This industry may discharge effluents in water sources too. For example, water pollution may also happen. And air pollution and water pollution is not going to affect only and only the suppliers and the buyers of the car. It is going to affect everyone. And it is going to affect them in a bad way. Therefore, this is called a negative externality. If there is a negative externality, these negative externalities have to be controlled. They have to be reduced. Now, will the producers or the buyers on their own volition control this pollution, control the amount of effluents which are being discharged both in the air and in the water. On their own volition, you cannot depend on them to voluntarily control this. Therefore, there is a requirement of an external regulation of the same. Who will do this external regulation? This will be the task of the government. Similarly, some goods have positive externalities, which means that the benefits of these goods do not remain constrained to those people who are selling them or to those people who are consuming them. The benefits of these goods are available or accrue to the general population at large. For example, education. For example, healthcare. Mind you, both education and healthcare are not public goods. Education is surely non-rivalrous, but education is excludable. We can stop people from sitting in our classes without paying any fees for it. Therefore, education is not a public good. Similarly, healthcare is both rivalrous in nature as well as excludable. If you are seeking a healthcare consultation from a doctor, another person at the same time, another patient cannot be simultaneously seeking consultation from the same doctor. It means the consumption of healthcare as a service is rivalrous to each other. Similarly, a doctor can tell patients that if they don't pay for his service, he is not going to give them any advice. So healthcare is also excludable in nature. Both education and healthcare, they are not public goods. Are they public goods? Certainly not. Yet, education and healthcare do not benefit only those people who are selling the service or who are buying the service. The benefits are available to the general population at large. A healthy workforce will also mean a workforce which has sufficient cognitive abilities, which has sufficient developmental abilities. A healthy workforce also would mean that the burden on the healthcare system, more specifically the public healthcare system, is also lesser. A healthy workforce will also mean that workers become far more available and they will be more efficient compared to sick people. So the benefit is for a general economy. Similarly, an educated workforce, educated people, you may have sought education, let's say university education or college education, to make yourself employable. The college benefits from your fees, but the benefits of educated people in the society accrue to just about everyone. Educated people will have far more civic sense compared to illiterate people, uneducated people. Educated people will also contribute so much more to innovation, which is going to benefit everybody across the society. These goods carry what is called positive externalities. The benefits of these goods, their consumption or their production, does not remain constrained only to the sellers or the buyers of these goods. They are available to the general population at large. And if you have such goods which carry positive externalities, these goods should be made available to all, because the society is going to benefit from them. Making these goods with positive externalities available to all is what is called public provisioning, which means that although these goods are not public goods, yet the government, knowing that these goods carry positive externalities, is going to finance the production of these goods and making sure that these goods are available to all. The financing of these goods through budget exercise by the government is what is called public provisioning. This again is the role of the government. Similarly, one more instance of market failure is called market power. What does it mean? It means sometimes producers may engage in restrictive practices, in unfair practices. They may display what is called monopolistic tendencies. And when this happens, this means that the benefits are cornered by a few. plus it hampers any innovation. If there is only one supplier of some item, it means that this supplier faces no competition from any other person, which means that this supplier has got no incentive to improve his good, improve his service. If there is only one supplier, it also means that this supplier is going to determine what the prices of these goods is going to be. This is called monopoly. A monopoly makes sure that only the producer benefits and benefits the most. Secondly, it also makes sure that producer has got no incentive to improve his good or improve his service. Now, a cure against each of these is what is called free and fair competition. Somebody will have to ensure that markets are thick, which means the number of buyers should also be very high. The number of sellers should also be very high. For instance, if we as a coaching institute start displaying monopolistic tendencies, we resort to restrictive trade practices. Let us say we book all of these spaces which are available in Delhi and we rent them out. We buy all of these properties and we do not allow any other competitive player to also give you the same coaching service. Then that means we are restricting trade. We are restricting trade. If we are the only suppliers of education to you, it means we are facing no competition, which means one, we can price our service any which way we want. Secondly, we may be willing to, or we may be able to sell you a low quality service even at a high price. And you will have no choice because there is no competition for us. Therefore, to ensure free and fair competition also, there is the requirement of a third party. This third party is going to be the government. Now, the cases of market failure build the case for government intervention. How will the government intervene? This government intervention is going to be in the form of production of public goods. It is going to be in the form of public provisioning of goods which may or may not be public goods. It is also in the form of general governance and regulation of markets. Now, each of these three functions will require resources. Public goods cannot be produced for free. Similarly, other goods which carry positive externalities such as healthcare, such as education, cannot be produced for free. This will require money. The government will require people who make laws, people who implement these laws, people who enforce these laws. These people will have to be paid. So this governance and regulation is also not going to be produced for free. The government is going to require resources for this. And where does the government get these resources or mobilize these resources from? The main way of mobilizing these resources is that the government gets the power of taxation. It is going to levy taxes on people, collect the resources, mobilize these resources, and then deploy these resources to perform its economic roles. That means the government will have to earn this money or get this money. Then the government will have to spend this money also. And budget is what? Budget or budgetary exercise is an exercise through which the government performs both of these functions. The function of taxing people to mobilize resources which the government is then going to use to produce public goods, to create public provisioning of other goods also, to regulate markets, to generally govern people. This is called redistribution function of the government. And spending money on the production of public goods, spending money on the provisioning of other goods, spending money on governance, on regulation of markets. All of this is what is called the expenditure function of the government, also called the allocation function of the government, which means the resources which have been mobilized by performing the redistribution function will then have to be allocated towards various uses. Both of these functions are what are called the functions of the government from an economic perspective. There is one more function of the government from an economic perspective, and this function is called the stabilization function. Now, what is the stabilization function? Remember, when we discussed GDP, we discussed something which is called aggregate demand. And aggregate demand is essentially speaking demand that comes from the agents of a society, which could be consumers, which could be firms, which could be government, and which could be the external sector. For some reason, consumption expenditure may decline, expenditure made by firms, investment expenditure, this may decline, or the external sector may witness some sort of a shock. All of these conditions will plummet the aggregate demand of the society, and when aggregate demand lowers, this will mean that supply of output in the economy shall also now be lower, which simply means the economy will produce less output. And if the economy is producing less output, simply means what? Simply means that the factors of production, they will be required lesser in volume, meaning that people will lose employment. There will be a problem of unemployment in the society. There may even be a problem of poverty in the society that may result from it. The other way around is also true. For some reason, consumption expenditure may increase beyond expectations. Investment expenditure may increase beyond expectations. The demand from the external sector may be increased beyond expectations. All of this will lead to a very high aggregate demand. And very high aggregate demand can put an inflationary pressure on the economy. Now, in these circumstances, we cannot rely completely on private forces such as consumers, such as firms, such as the external sector to automatically stabilize the economy. The government will have to enter and the government will have to stabilize the economy, bring back your aggregate demand to a level where the economy becomes a little stable. Which means when the aggregate demand is being lowered, the government may increase its own expenditure, or the government may cut taxes on consumers, may cut taxes on firms so that they increase their expenditure, bringing the aggregate demand upwards. Similarly, when the aggregate demand is very high, in this circumstance, what the government can do is that the government may reduce its own expenditure, or the government may start to tax consumers, tax firms so much more, so that consumers and firms, they spend lesser. All of this is being done for the government to stabilize the economy. This function of the government is called the stabilization function of the government. Now, what is budget? Budget is essentially that exercise through which the government performs its three functions. It performs its allocation function, it performs its redistribution function, and through which it performs its stabilization function. The budgetary exercise is that exercise of the government through which the government performs its economic role. It mobilizes resources by performing its redistribution function. It allocates those resources, and then it also, through its expenditure and its taxation functions, tries to stabilize the economy itself. This is what the economic perspective on budget as an exercise is all about. Now let us get into the details of what budget essentially means. Article 112 puts a constitutional obligation on the central government to present in the House of the Parliament every year something which is called an annual financial statement. What will this statement contain? The annual financial statement is going to be a statement of the government's estimated receipts and the government's estimated expenditure in the upcoming financial year. Now, what is a financial year? From accounting perspective, a financial year begins from the 1st of April, year X, to the 31st of March, year X plus 1. Which means the Constitution puts an obligation on the government that the government will have to present before the houses of the parliament a statement annually. This annual statement shall be a financial statement because it is going to contain the estimates of how much money the government is estimated to receive in the upcoming financial year and the estimates of how much money it is going to spend in the upcoming financial year. Which means normally a budget is presented on the 1st of February of every year. Which means that there is an ongoing financial year. In this ongoing financial year, on the 1st of February, the finance minister is going to present before the houses of the parliament an annual financial statement stating that the government expects to receive so much money in the upcoming financial year, which it plans to spend on so and so items in the upcoming financial year. This annual financial statement is what we popularly call budget. Mind you, the word budget does not appear in the Constitution. The technical name for it is annual financial statement. Now, next thing we have to know is the classification of items, or you can say the components of budget. The classification of items meaning receipts and expenditure in the budget or the components of budget. Now, what can be the components of budget in here? When the finance minister presents a statement of estimated receipts and estimated expenditure, these estimated receipts and expenditure are classified under two heads. One head is called the revenue head, and the other head is what is called the capital head. Which means the government is going to do what? The government is going to classify all its receipts and all its expenses broadly across these two heads. The revenue head will contain two things. It will contain estimates on revenue receipts. It will also contain estimates on revenue expenditure. And what will the capital head contain? The capital head will contain estimates of capital receipts and also estimates on capital expenditure. Now, receipts simply mean where the government is going to receive money from. And expenditure or expenses simply means where the government is planning to spend this money. In the case with capital receipts, this will be the different sources of money where the government is going to receive the money from, and capital expenditure would be expenditure of the government, which means where the government is going to plan to spend this money. Now, what is the difference between the two? We have a positive definition for the capital head. The positive definition is all such receipts, all such expenditure of the central government which will have an impact on the asset liability structure of the central government, those will be classified under the capital head. Meaning that for the revenue head, we have a negative definition, simply meaning what? Those receipts, those expenditures which do not impact the asset liability structure of the central government. Now, what are assets? You can think of assets as those things which promise a future benefit to the government. What are liabilities? Liabilities are something that the government owes, the government has to pay back. Those receipts, those expenditures which will impact the asset liability structure of the government will be called capital receipts and capital expenditure. They will be classified under the capital head. While those receipts, those expenditures which do not have any impact on the asset liability structure of the government, those will go under the revenue head. Now, what goes under the revenue head? What are your revenue receipts? And which are your revenue expenditures? There will be two types of revenue receipts. One is called tax receipts. The other one is called non-tax receipts. Tax receipts will include both taxes, direct as well as indirect taxes. While non-tax receipts will include, firstly, user charges. The government is providing public goods. The government is creating a public provisioning of goods, which means that the government may sometimes impose on you some user charges. The government collects, for example, money on rail transportation, right? The government sells tickets. The government also collects some money or imposes upon you a fee if you are using the postal service of the government. The government imposes upon you user charges for using water. All of those are what you call user charges. Similarly, the government may receive dividends from the companies where it has shareholding. There are many companies which are government-owned companies, such as public sector undertakings. When these companies make any profits, that part of the profit which they distribute to the government will be called dividend. And these dividends will also be a source of money for the government, creating no obligation on it. Apart from this, the government has also given loans to the state governments, to union territories. Any interest money received on the loans that the government has given away, that will be a part of non-tax receipts. Apart from this, any gifts, grants, aid or donation that the government is not obliged to return back will also be a part of non-tax receipts. Similarly, what will be the revenue expenditure? Such expenditure which will not impact the asset liability structure of the government. Now, this expenditure can be made on the following heads: expenditure made on salaries, expenditure made on pensions, expenditure made on what is called transfer payments, such as scholarships. In fact, pension is an example of transfer payments itself. Scholarships, subsidies, gifts, donations, etc. Such payments which originate from the government, when they are received by the beneficiary, those people do not have to do anything for the government. Those will be called transfer payments. They will be included as part of revenue expenditure. Apart from this, the government has also taken loans. On those loans, the interest payments, or what you may want to call the interest obligations on loans taken, those will be classified under the revenue expenditure. Apart from this, expenditure made on defense. Mind you, defense expenditure is classified across both heads, one capital head, the other one the revenue head. Here the defense expenditure is defense revenue expenditure, meaning what? Meaning salaries, allowances, canteen stores departments, transportation, etc. This means the general working capital requirements of the defense forces. Not just this, one more thing which is going to be included here is going to be what is called administrative expenses, which simply means the maintenance of assets that the government has acquired. All of these expenses get classified under what is called the revenue expenditure. If you look very closely, revenue expenditure is the expenditure which the government requires for its day-to-day functioning, for its own survival. The government cannot survive if it is not paying salaries. The government cannot unilaterally stop pension payments. The government has to make interest payments on the loans that it has taken. The government has to spend working capital on defense forces also. This is money which is required by the government to exist, to perform its core activities. Without this, the government's day-to-day survival is going to become very, very difficult. Now, let's go back to the capital head. What comes under the capital head? As part of the capital head, we have what is called capital receipts, as well as capital expenditure. Now, what are capital receipts? This is where the government is going to get money from. Capital receipts can be fundamentally of two types: debt receipts, also called non-debt receipts. Two types: debt receipts, non-debt receipts. Debt receipts meaning what? Debt receipts meaning money that the government is going to borrow from internal as well as external sources. Non-debt receipts means what? This will be the repayment, principal on loans granted by the central government. That means the government has given loans. When the borrower is returning the principal amount to the central government, the government has received the principal on the loans that it had granted. This will be one source of money. The other source of money is called proceeds of disinvestment. Now, what is proceeds of disinvestment? It means that the government is selling off the shares in its own companies. For example, privatization of BSNL. If government tomorrow wants some more money, it can sell off its shareholding in LIC. It can sell off its shareholding in BSNL. It can sell off some part of its shareholding in NTPC and collect money from that sale. This is what is called proceeds of disinvestment, which means offloading shareholding, offloading equity investments across many companies that the government has equity in. Then capital expenditure. Fundamentally, capital expenditure will be of two types. One, the government also has to give back the principal on the loans that it has taken, which means repayment of the principal on the loans taken by the central government. This will be one kind of a kharcha, one kind of an expenditure. Apart from this, the government may use money for investment purposes. And investment here would be of two types: investment to build real assets, investment to build financial assets. For example, if the government is spending money on bridge infrastructure, on roads, on ports, on airways, this is investment in infrastructure, and infrastructure is a real asset. If the government is buying, let's say, Rafale jets for its defense forces, Rafale jets are real assets. The government is spending money on assets which are going to increase the productivity of our defense forces. This is going to be called investment in real assets. Similarly, the government may subscribe to financial instruments or financial securities. It may buy shareholding in some companies. It may nationalize some companies. Right? It may buy debt securities. When the government is spending money on acquiring financial assets, this is also investment, but investment in financial assets. Now, when you look very closely, you will find that capital expenditure has the impact of doing what? If the government is repaying the principal on the loans taken, which means the government had a liability, the loan was a liability on the government had to repay this liability, the government is reducing its liabilities. Or the government is spending the money to build real assets or to build financial assets, which means this expenditure is going to increase assets. When you look at the receipt side, on the receipt side, where is the government collecting money from? The government can take a borrowing. That means the government is increasing liabilities onto itself. The other ways of government getting capital receipts is when it proceeds to disinvest some of its companies, when it proceeds to sell off the shareholding of some of its companies, meaning that government had some assets and it is selling off those assets. When you get a question in your examination, you only have to think whether a receipt or an expenditure is going to have an impact on the liabilities, on the assets of the central government, and if they do, they will be classified under the capital head. Capital receipts are those sources of money which increase the liabilities on the government or reduce the government's assets. Similarly, capital expenditure is that kind of money spent by the government which will reduce its liabilities or build its assets. So all of these expenditures or receipts which impact the asset liability structure of the central government will be a part of capital head, simply meaning the residual items go where they go under the revenue head itself. Now, one more important thing that you have to know in this chapter is the concept of deficit. Now, the word deficit arises from the word deficiency. And since we are talking about public finance, this is going to be deficiency of funds. What is a deficit going to mean? A deficit simply means that the government plans to make some expenditure, but this expenditure requirement is more than the government's receipts. You can think of it like this, like in your case, if you want to buy a bike, the bike costs you 7 lakh rupees, but you only have 5 lakh rupees. Meaning what? Meaning that you are facing a deficiency of 2 lakh rupees. You have a deficit of 2 lakh rupees. Same applies in the context of public finance management too. When the government plans to make a certain expenditure and the government does not have as much money to make that expenditure, the government is said to be facing a deficit. It has a deficiency of funds. And whenever it faces a deficit, this deficit has to be bridged by borrowing money. A few types of deficits that you have to remember for your exam perspective. First deficit that you have to know is what is called revenue deficit. What is revenue deficit? To define it very simply, it is a deficiency of funds. It's a deficit on the revenue account of the government. Simply meaning what? If the government's estimated revenue expenditure is going to be more than the government's estimated revenue receipts. This means that the money that the government requires for its day-to-day functioning, the money that the government may require for this is less than the money that the government is collecting from its revenue receipts, which is going to include tax revenue and non-tax revenue receipts. This kind of a deficit is going to be called revenue deficit. Revenue deficit simply equals revenue expenditure minus revenue receipts. And it simply means what? It simply means that the government is unable to collect as much taxes, is unable to collect as much user charges, it is unable to get this kind of money to make an expenditure which is absolutely critical for its day-to-day functioning. Therefore, any kind of revenue deficit is bad for the government. The government does not have enough money from its revenue receipts to carry out an expenditure which is critical to its day-to-day functioning. It is unable to pay off salaries, it is unable to pay off its pensions, it is unable to pay interest on the loans that it has taken. This kind of a deficit is going to be called revenue deficit, and any type of revenue deficit is simply bad because it indicates that the cost of running the government is more than the amount of money that the government can rightfully collect from you in the form of taxes or in the form of non-tax receipts. Which simply means that if the government has to make this kind of expenditure, it will then have to get this money from the capital head. Can you imagine a circumstance where the government is saying that we want to spend 100 crore rupees in the next year, but from our tax receipts and our non-tax receipts under the revenue head, we only have 50 crore rupees, which means we are facing a revenue deficit of 50 crore rupees. This money is absolutely critical for the day-to-day functioning of the government and therefore will have to be sourced. Where will you source this revenue deficit from? You will source this revenue deficit from your capital head. You will have to get this money to capital receipts. And what are capital receipts? They are fundamentally either debt, the government may have to borrow this money, or the government may have to sell off some of its assets or expect to get the principal on the loans that it had taken back. Simply meaning for the day-to-day functioning of the government may even be forced to sell off its assets or to even borrow money to carry out its day-to-day functioning. Therefore, any kind of revenue deficit is bad for the government and for the general economy. The second type of deficit that you have to be sure of is what is called fiscal deficit, gross fiscal deficit. And what is gross fiscal deficit? It is defined as the excess of government's total expenditure over its non-debt receipts. To understand it simply, it means how much money is the government collecting without borrowing and how much money does the government plan to spend in total in the upcoming financial year. If the government's total expenditure, which is going to be a sum total of government's revenue expenditure plus capital expenditure, if the government's total expenditure is greater than its non-debt receipts, the government is then said to be incurring what is called a fiscal deficit. And a gross fiscal deficit simply would be total expenditure of the government minus the government's non-debt receipts. Now, once again, total expenditure will include what all? It will include revenue expenditure plus capital expenditure, and non-debt receipts will include all revenue receipts, because no revenue receipt is a borrowing on the government, and it is going to include only one part of the capital receipts, which is called non-debt capital receipts. Because capital receipts are of two types, debt receipts and non-debt receipts. Non-debt capital receipts will include what all? It will include proceeds from disinvestment plus any principal amount that the government gets back on the loans that it had granted. If the government's total expenditure is more than the amount of money that the government is going to collect without borrowing, it simply means that the government is incurring a gross fiscal deficit. For instance, if the total expenditure requirement of the government is, let's say, 100 crores and its revenue receipts and non-debt capital receipts total to up to, let's say, 80 crores, then the government is going to face a gross fiscal deficit of 20 crores. And what is going to be the source of this 20 crores? How is the government going to get these 20 crores? Of course, the government is going to get this 20 crores by borrowing this money. Gross fiscal deficit is an indicator of the fresh borrowing requirements of the government, which means in the upcoming financial year, the government wants to make a total expenditure of 100 crores. Without borrowing any money, it is going to collect 80 crores. That means it is facing a fiscal deficit, a deficiency of 20 crore rupees, which it will finance by issuing fresh loans, by borrowing this money. Simply meaning what? How do we finance this fiscal deficit? Or what do they indicate? They indicate government's fresh borrowing requirements. Get this? Now there is one more type of deficit that you need to know, which is primary deficit. What is primary deficit going to mean? Primary deficit is going to be gross fiscal deficit minus the interest obligations on the government, which means the gross fiscal deficit, this is a representation of the government's fresh borrowing requirements, how much money the government is going to borrow in the upcoming financial year, and what part of this money is going to be paid to make interest payments on the loans that the government had already taken. Fresh borrowing requirements minus interest obligations on the central government. That means loans that it had taken previously, on those loans the government will have to pay a periodic interest. When we deduct these interest payments, which the government has to make in the upcoming financial year, from its fresh borrowing requirements, what we get is what is called a primary deficit. It indicates what? It indicates how much of the fresh loans will be spent on the current expenditure requirements of the government. Because interest obligations are past obligations. Remember, these are interest obligations on the central government for loans it has taken previously. Which means if I am going to, in the upcoming financial year, going to borrow, let's say 20 crore rupees, how much of these 20 crore rupees, this deficit is going to be spent on one type of revenue expenditure, which was interest payments. And interest has to be paid on loans which have already been taken, simply meaning what part of the government's expenditure requirements are going to go on the government's present obligations. This is what the representation of primary deficit is all about. Now, with that said, you have covered the chapter on budget as an exercise. We have covered the role of the government. We have covered what budget as an exercise means. We have covered the classification of budgetary items. And then we have covered the deficit. What do they mean? How do we finance those deficits? What are the implications? In the next chapter, which will be our last chapter on the NCERT Wala series, we'll be covering the external sector. Till that time, I wish you a goodbye and good luck. Thank you.